Good morning and welcome everyone, and thank you for joining us today for our Winter Tax Forum. My name is Farhad Agdami. I'm a partner in the tax section as well as a private client and fiduciary services practice here at Williams Mullen, and I'm joined today by my tax section colleague, Anna Darawinda, and we're both based out of the Richmond office. Before we begin our program, I have a few housekeeping items. First, at any point during the presentation, you can submit questions by using the Q&A button at the bottom of your screen. We'll address the questions as time permits, and if we don't get to your particular question, we'll follow up with you. Second, if you are having any audio or technical problems, please use that same Q&A button, and our folks will see what we can do to help resolve that. Our program has been approved for 1 credit hour of CPE credit, and our application for 1 hour of CFP credit is pending. This afternoon, you'll receive an email with a certificate of attendance for CPE, and we'll send a separate email when our CFP credit has been approved. And if you can go to the next slide, I want to announce that our 13th annual Fiduciary Focus webinar is going to be held on Friday, February 25th. An invitation for this event will be coming out shortly, but if you'd like to be added to the mailing list for the event, you can put your email address in the Zoom chat now, and we'll make sure that you get that invitation. So going to the next slide, here's a quick look at today's agenda. I'm going to be kicking things off with some recent developments in wealth transfer tax planning and the Build Back Better plan of what might be revisited. And then from there, Anna's going to speak on some tax trends in M&A transactions. So with that, let's get started with recent developments in wealth transfer tax planning. I guess going to the next slide, Anna. The first thing I want to cover is IRS released the annual inflation adjustments for a number of wealth transfer tax items. The estate and gift and GST exemption amount increased from $11.7 million to $12,060,000 this year. I liked 11.7 because it was a nice round number, whereas 12,060,000 just doesn't roll off the tongue. But it's a $360,000 increase, which is substantial, which I think is reflected in inflation. We're seeing inflation, and it's certainly reflected in the CPI numbers. The gift tax annual exclusion finally jumped from $15,000 to $16,000. In order for it to get to the next number, for it to get up to the next $1,000 increment, actually has to get over 16,000, and so it finally got over. And so this year it's gone up that $1,000. There's also annual exclusion for gifts to non-U.S. citizen spouses. That went up to $164,000. It's typically 10 times the gift tax annual exclusion, and kind of gives you an insight as to where sort of that inflation adjusted number is, going from 15 to 16. And there's some other miscellaneous type for section 6166 and 2032A. Those numbers have gone up also. One other point I want to make is, the top income tax bracket for the income taxation of trusts and estates is very low. So trusts and estates reach the top bracket very quickly. That number this year is $13,450. A thing I always like to remind people is, keeping taxable income inside an estate or trust is not very tax efficient because you reach the top rate so quickly. But you do have the ability to make what's called a section 663B election. It's also referred to colloquially as the 65-day rule, and allows you to make a distribution 65 days after the close of the calendar year or fiscal year, whichever year you're on, and treat that distribution as having been made in the prior year. And what it really allows you to do is figure out how much taxable income you had during the year. And I think by, maybe March 5th of this year, make a distribution, and that will carry out D&I to the beneficiaries, which means that income is not going to be taxed to the trust. It'll be carried out to the beneficiaries. And so it's always a smart idea to kind of take a look at it this time of year, particularly once you get your 1099s and those kinds of things in. Next slide, I want to talk about what's happened a little bit with the Build Back Better. So I think during our last tax forum, whatever hair I had fallen out because I was so worried about what was happening with this, the House's reconciliation bill. And there were really three provisions in that bill. The September 13th version of the bill had three provisions that were quite worrisome. First, they were proposing a reduction of, or an acceleration of the reduction of the estate and gift tax and GST exemption amount back to $5 million, but it would happen earlier than scheduled. So under current law, it's scheduled to drop back down to the $5 million inflation adjusted number in 2026. What they were proposing is to have that drop back down in January of 2022, so a 4-year acceleration. On top of that, they were proposing basically the elimination of valuation discounts for non-operating entities. So if you have an operating business, you could take valuation discounts, but if you had, I would say, sort of a typical family limited partnership funded with marketable securities, then you're probably not going to be able to take valuation discounts anymore. And probably the biggest change that frankly, gave me the most worry was a number of changes to the grantor trust rules that would have substantially really curtailed our ability to affect sales to grantor trusts, to set up GRATs, to do qualified personal residence trust QPERTs, and also grantor charitable lead annuity trust. And it was a pretty significant change. I mean, I think you had, going back to 1985, you had a series of, I would say, seminal rulings that supported the use of grantor trust and planning with grantor trust, and sort of in one fell swoop, they eviscerated all of that, or proposing to eviscerate that, and frankly upset a number of other provisions. Thankfully, 45 days later, on October 28th, the next version of the House bill dropped those provisions, and they were not found in the future in the provision, the bill that was passed by the House, and we have not seen anything more about that. I know that there are some rumblings about doing another version of Build Back Better and maybe pare down, but I'm hopeful that if these were taken out very quickly, that they will not find their way back in. If we could go to the next slide, talk a little bit about, are we safe now? Is this something, that we should continue to be worried about, or, will these provisions find their way back? At this point, Senators Joe Manchin and Kristen Sinema have opposed the Build Back Better bill, and they've had different reasons for their opposition. But at this point, the Democrats have not been able to move this bill forward, and it's questionable whether or not they will have the votes. It may be reconfigured. As we look forward towards November, you've got the midterm elections, and there's certainly the potential shift in congressional control, a shift in the House and the Senate, in those elections. And if that is the case, if there's a shift in the House and the Senate, or either house, either branch, then it's not likely that we will really see these provisions resurrected until really after the 2024 elections, and until 2025, which coincidentally is really when a lot of the provisions in the Tax Cuts and Jobs Act from 2017 will terminate. Certainly the estate and gift tax exemption will revert at the end of 2025. So, our hope is we've, sort of dodged a bullet, and that it may not be coming back for a number of years, but it doesn't mean that the landscape won't change. I think certainly the Biden administration, sort of taking a page out of the Obama administration's frustration with Congress, really look to implement a lot of regulatory action to sort of circumvent what they couldn't do legislatively. And so there is the possibility that IRS and Treasury could issue regulations dealing with valuation discounts. There were regulations that were issued in 2016 under Section 2704. Those could potentially be resurrected in some other format. And then the IRS could revisit these revenue rulings that they've issued, really going back to 1985, Revenue Ruling 8513, talking about how transactions between a grantor and a grantor trust are disregarded for income tax purposes. Revenue Ruling 2004-64, dealing with income tax payments with respect to grantor trust not being a gift, and 2008-22, the substitution power not being retained interest. So they could perhaps revoke these prior rulings and, at least have a chilling effect on future planning. So, we just don't know what will happen. I think we're resuming the planning that we had been doing, but just understand that there may be additional regulatory guidance coming into place of legislative action. If we can go to the next slide, I want to talk about a few some case law that came out. The first is a little bit of a head scratcher for me because frankly I thought this was pretty settled law. You had a guy named Peter Buck, and those who are music fans know that there was a guy named Peter Buck who was in REM. I'm not sure if it's the same Peter Buck, but this is a guy that bought about $100 million worth of real estate land, I think in Vermont. I think it was timberland in Vermont, and he gifted 48% fractional interests in the real estate to his two sons. And he said, these are fractional interest discounts and are fractional interest in property. And because, it's not as appealing as owning 100% of the property, and because your remedy is going to be a partition suit, there should be, valuation discounts applied. And the IRS really, which is kind of surprising, they said, well, Mr. Buck owned 100% of the property when he gifted it, and he gifted these 48% interests, and so no discount should be allowed because he had control when he made the gifts. And it's a little bit of a head scratcher because Revenue Ruling 9312 is essentially identical facts, not quite, but pretty close, where the taxpayer owned 100% of the stock of a company. He gave 30% to each of his three children. So he owned 100% and gave 30%, all minority interest discounted assets, to his children. And the IRS said that's okay, and all three of those separate interests can be discounted. So not surprisingly, the Federal District Court in Connecticut said that the IRS's theories just aren't supported by case law. And for gift tax purposes, you're not valuing what the person held when they made the gift or what is created when it arrives at its destination. You're valuing what is being transferred, when it's leaving the transferor's hand and it's sort of in the ether traveling to the transferee, what is being transferred. And that's really a 40% interest that's going to an individual that's a minority interest, and so it should be discounted. So I'm frankly surprised that, and maybe the taxpayer is going to seek cost, because I don't think this is a position that really was supported in the case law at all. Going to the next slide, we've got the Nelson case, and this is the Fifth Circuit Court of Appeals. I think we've spoken about this case before, but this is where someone tried to do what's sort of referred to as a defined value clause or a formula type clause, where they're gifting interest. They don't know what the value of the interests are. And they basically said that they're giving, X interest having a value, let's say, of $15,000. So it's an annual exclusion gift, having an interest valued at $15,000. And they said fair market value is going to be determined by a qualified appraiser within 90 days of the effective date of the agreement. The problem is that they're transferring, $15,000 worth of interest as determined by the appraiser. And really, the case law that has supported this type of planning has been focused, and this is both in Wandry and in the McCourt cases, that it's really tied to $15,000 of interest as finally determined for federal tax purposes, or as finally determined by the willing buyer, willing seller test used in the Treasury regulation. So it was the facts that they said that this is going to be the value as determined by the appraiser, as opposed to saying as finally determined for federal gift tax purposes. That was a differentiator, and so the taxpayer was not successful, and the IRS was able to sustain a challenge saying this clause was not effective. And the Fifth Circuit, supported that, the tax court's determination. The next case, going to the next slide, is the Smaldino case, and this one is a little bit is a little troubling. This is really a case involving the step transaction doctrine. Here you had a situation where Mr. Smaldino had children from a prior marriage, and he had remarried, and he formed an LLC. And after forming the LLC, he gifted a 41% interest in the LLC to his wife. And then his wife, basically the next day, gifted that 41% interest to a trust for the benefit of his children from a prior marriage. And the wife filed the gift tax return reporting the gift as being made by her. And what the IRS essentially said was this was really an indirect gift by the husband. And because there was such a short period of time between when he made the gift to her and then she turned around and re-gifted it to a trust for the benefit of his children, the IRS said that the step transaction doctrine should apply and really look through that and really treat it as a gift as having been made by the husband. I think the issue here was the husband had essentially used the entirety of his $11 million gift tax exemption, whereas the wife had only used about $3 million of her gift tax exemption. So she had about $8 million of gift exemption available. And she said, well, I'll go ahead and make the gift and have it, and I'll go ahead and use up my exemption. They couldn't split gifts because if you split the gift, if it was an $8 million gift, the husband would have had deemed to have been made a $4 million gift, and that would have been over the amount. And so they positioned the assets this way, which I think, the planning could have worked, but I think in order for you to avoid the step transaction doctrine, I think you need to have more than one day between the first transfer and the second transfer, and there needs to be something something needs to happen. The wife in this case needs to have exercised some dominion and control over the asset, voted if these are marketable securities, made some trades, taken some distributions out of the account, treated as if it were her own. And I think you can potentially get around the application of the doctrine, but making the transfer and then a subsequent transfer a day later, I think made them susceptible to this argument. So I know, at year end, folks are moving assets around, trying to fund trusts and make gifts. And I think this is, this is a little bit of a shot across the bow to be careful and be mindful that the step transaction doctrine can apply. Going to the next case, we've got Chief Counsel Advice 2021-52-018. And this is one that is also, I think, is frankly frightened a number of practitioners who are, who are using GRATs. The facts of this case, frankly, are not too dissimilar from facts that I see in my own practice. And a situation where the taxpayer founded a company, became very successful, and was getting ready to entertain potential offers to sell the business. So he hired some investment bankers to market the company for sale, and started getting indications of interest to sell the property, sell the company, and for a substantial amount of money. At the same time, so the taxpayer, while he's getting these indications of interest, he's also gotten valuations that set the value of the shares that were contributed to the GRAT at a very low value. So as many of you know, a GRAT, you transfer assets to the GRAT at a certain value. You receive from the GRAT assets having that initial value based on the initial contribution. And then any appreciation is shifted out of your estate gift tax free. And so while the taxpayer is getting these indications of interest from the investment bankers for certain values, is relying on a outdated appraisal that had the company valued at a very low value. What further compounds it is several months later, the taxpayer, I guess talking out of the other side of his mouth, set up a charitable remainder trust and contributed the assets to that charitable remainder trust using basically full fair market value. At, after the few months, they started going down the path, had a letter of intent, had a transaction price, and essentially contributed those shares to the charitable remainder trust at a much higher value. And obviously he's incented in that instance to have the contribution be valued as high as possible, because that will make his charitable income tax deduction that much larger. So for GRATs, you want it to be as low as possible. For the charitable remainder trust, you want to be as high as possible. And I think one of the issues in this case, in this planning, was that the taxpayer, frankly, was inconsistent, was used, a very low value one place and a very high value at the other, and also using outdated appraisals. The chief counsel advice, and this is really internal advice from a field agent from the chief counsel's office on how do you, analyze these facts. And what the chief counsel's advice said is that the GRAT, while it met all of the technical requirements of a valid GRAT, is disqualified because the valuations that they were using to make the annual annuity payments really bore no relation to fair market value, and therefore the trustee failed to make the adequate annuity payments. So if, for example, let's say the GRAT said the value of the company is $100 million, and they're making GRAT annuity payments based on a $100 million valuation, and the chief counsel's advice tells us that the company was valued in the billions of dollars. So let's say, 3 months later, it's now valued for $1 billion. Well, your annuity payments are 1/10 of what they should have been. And there's a case that goes back a number of years called Atkinson that dealt with a charitable remainder trust. And basically, it was a charitable remainder trust that met all the technical requirements, but it was just poorly administered. They didn't make the distributions on a timely basis. And the court basically kind of handed down the death penalty, said your charitable remainder trust was so poorly administered, we're just going to treat it as being sort of void from inception. And the chief counsel's office, essentially relying on Atkinson, said this valuation was so terrible and your annuity payments are so off reality of what they should have been. We're just not going to treat this GRAT as being qualified from the outset. And the consequence there is really horrible, because basically whatever was contributed to the GRAT is now treated as a taxable gift. You don't get to take into consideration the annuity interests that are coming back because they're not qualified interests. And they're probably using not the $100,000 value in valuing the gift, or $100 million value in valuing the gift. They're using the $1 billion value. So this is really just kind of a disastrous result. And it is something I think, folks really need to be mindful of when they're setting up GRATs, and they're in sort of the pre-transaction swirl where values are kind of all over the place. I think you really need to stop and take a look at this case and think about the potential consequences and the risks. I think there are some avenues of defense, and if we go to the next slide, I can talk about some things that folks may want to at least consider. And this is what the chief counsel basically said is, the trustee's failure to satisfy the fixed amount requirement is an operational failure because the trustee paid an amount that had no relation to the initial fair market value. And they were based on an outdating and misleading appraisal of the company when the company had received offers in the multi-billion-dollar range. When asked about the use of the appraisal, they said that the business operations really hadn't changed in the 6-month period, so they went ahead and used it. But when they, were making the contribution for the charitable trust, they used an appraisal that really focused on the tender offer. So it's that inconsistent really that really hung them. If we go to the next slide, I think there are some ways to avoid these issues. First, get current appraisals and include all the relevant facts. So, I tell clients all the time, whenever we're doing, planning involving a closely held interest, the absolute best money you can spend is on your valuations, because the issues that the issues that we see on audit revolve around valuation, and those are typically factual issues. It's sort of interesting that now a factual issue around valuation has bubbled up into a legal issue, that is, you have a disqualified GRAT. So, I can't stress enough the importance of getting current valuations, and also disclosing, the relevant facts that you're in discussions with investment bankers, because I think the failure to disclose that, which it will come out in discovery, is fatal. And so I think it's important to be mindful of that. The second thing is, think about competing planning. So here they're doing the GRAT on one end, but they're also doing the charitable remainder trust at the other end, and they're being inconsistent. They want a low value here and a high value there. And I think they just need to recognize that doing that type of planning is going to make them susceptible. Creating as much as wide a window in time ahead of, ideally before the investment bankers are hired, I think really sets you up well for doing the GRAT. I did not see the specific terms of the GRAT, but typically when we draft a GRAT, we say that the annuity payment is tied to the value of the assets contributed as finally determined for federal gift tax purposes. So if there's a change in value on audit, then the annuity payments will self-adjust and go up in value to reflect that change in value. That may or may not have been included in the GRAT, we don't know, but that at least is one argument to go back to the service and say, look, we undervalued it, slap us on the wrist, we'll adjust the payments. We in our documents, we actually go one step further and include a undervaluation or overvaluation provision that allows you to make additional payments if the assets are not valued correctly. And then we actually also include what we call an anti-Atkinson clause that really deals with the situation where if you miss the payment or you make an untimely payment, there's a mechanism to kind of correct that. So I think these are the case is troubling. There are some ways to mitigate that. I think once again, your best defense is a timely appraisal, a contemporaneous appraisal that reflects all these things. So with that, I will. I think I've got a minute or two for some questions. Let me see if there are any. So one of the questions is, in light of comments made regarding regulatory changes, are you still drafting GRATs and SLATs? And the answer is yes, we are. We're at this point, there's been no change in legislation. Obviously, we're keeping an eye on what's happening, but letting clients, keeping them aware of the risks and what's happening in the legislative landscape. But we think that you can go ahead and proceed, on this basis, but obviously doing it with your eyes open. So at this point, I'm going to stop speaking. I'm going to turn things over to Anna, who's going to give us an update on M&A transactions. So thank you.
And thanks, Farhad, and thanks everyone for joining us today. So I'm going to sort of switch gears and talk about the business tax side of things and the individual tax side of things. And to start off this new 2022 year, we thought it would be nice to sort of take a breath and reflect on 2021, since it was another sort of crazy year, both in terms of some of the proposed legislation and some of the M&A. We're seeing reports everywhere that it was a record-breaking year. And so whether you're in the M&A space or not, I'm sure you were touched by the effect of all of that activity. So just to start off with, to loop it back to Farhad's conversation on the Build Back Better Act, we just wanted to sort of go through and see what some of the proposals were. So starting with some of the business tax side. So the key ones, and there were a lot out there, and I've only included a few on here, mainly dealing with the tax rates, but there were proposals around the interest limitation, beat foreign tax credit limitations, elimination of the 1-month deferral, 958B4 restoration, some discussion around 355 and 361, and deferral of losses in liquidation. So there were quite a lot of details out there, but as far as sort of the big ticket items, it was around rates. And so for corporations, initially the House had proposed an increase from the 21% rate to sort of more graduated rates with a maximum rate of 26.5. This was one of the points of discussion. And so the graduated rates were dropped in the House passed bill, and instead there was a new C corporation minimum tax of 15% on adjusted financial statement income. Luckily for most of our mid-market clients, that it was not going to apply because it was limited to companies with over $1 billion in profits. And then on the foreign tax side, because of the OECD agreement and plan on a global minimum tax, there were some rate plays on the deductions for GILTI and for FDII, just trying to make sure that the deductions resulted in combination with whatever the corporate rate was going to be, resulted in at least a 15% effective tax rate. And there were some other nuances that were made to sort of having the benefit of, in the last 5 years now, since I guess 4 or 5 years now since the TCJA, sort of having the benefit of some of the issues that have been cropping up and discussions that have been happening, country by country proposals, dropping the QBI down to 5% from 10% and giving a 95% foreign tax credit rather than the 80%. And so there was sort of general, it seemed like some agreement with the Senate with some tweaks. The Senate proposals had an addition of the expansion of anti-inversion rules, and then also proposed a 1% tax on stock buybacks from publicly traded companies. But then going to some of the individual rates, so it was sort of a similar scene. We saw, quite a few proposals out there in terms of increasing tax rates, and those had to be modified because some of the senators, Sinema, were sort of anxious about increases in tax rates. So when we started out with the individual tax rate, an increase of that from 37 up to 39.6, along with a 3% surtax on income in excess of 5 million. That increase in the marginal rate was removed, and instead they went with a 5% surcharge for income over 10 million and a 3% surcharge for income over 25 million. The House also proposed to expand the definition of the net investment income tax to include business income unless FICA already applied to it. And that remained in the House passed bill. And so, we had those conversations at the end of last year because a lot of folks were interested in converting their LLCs into S corporations to avoid the self-employment tax. And, when we started looking at the numbers, if this expansion of the NII came into place, it effectively for S corporations put you in the same place as having that self-employment tax. So there may be other reasons to convert your LLC into an S corporation, but that was certainly one of them. So, if this is raised again, I'm sure we'll be having those discussions again. So we saw the increase in capital gains rate was initially proposed from 20% to 25%. That ended up being dropped, I think, in favor of the 5% and the 3% surcharges. The carried interest holding period was proposed to increase from 3 years to 5 years. That provision was removed in the House passed bill. Another interesting one was the Section 1202 exclusion. So we've had a lot of activity around this in the last couple of years because under Section 1202, you can exclude up to potentially 100% of the gains on the sale of C corporation stock. And this was originally intended as an incentive, especially for tech companies, for investors in tech companies. And I think there's, people are starting to maybe review this and, is it being used as a loophole? I think there was an article recently in the New York Times that was looking at this provision. So the House proposal reduce that exclusion. So it would still be there, but it would be reduced down to 50% with the way those rules work if the income is over 400,000. And, you know, most of our deals, that's, you know, they're over that 400,000. So that could be a big deal too. Investors, especially on the VC side, where I think they've been really taking advantage of that 1202. There was also a proposal to limit the 199A deduction to a max of 500,000, but that appears to have been removed. And then another interesting one was 461L. So 461L basically disallows a deduction for business losses. This provision was added in the TCJA. You know, we're so used to disallowance for capital losses, but 461L disallows a deduction for business losses in excess of 250,000. And that was scheduled to expire after 2025. It was paused, its application was paused in the CARES Act until 2021. But the House proposal basically makes 461L permanent, and it also has a tweak in terms of how carryover losses would be treated, because under the current rules, if you are in excess of the 250,000, your excess losses carry over to the next year's an NOL, and then they are not subject to 461L again in the next year. But so it's a little bit of a timing play. And so the proposal would treat them as excess losses, so they would be subject to the limitation in the following years. So, and then the big elephant in the room was, of course, the SALT deduction. So currently capped at 10,000, discussion about increasing it to 80,000. And so it's a little bit frustrating because you can see based on these slides that there was a lot of agreement between the Senate and the House, but there were just some things that they couldn't compromise on. So the Senate proposal that we saw come out just really included a placeholder for a compromise. So, you know, in terms of what we're expecting to see next, you know, I think as Farhad was saying, it's the Democrats are in a difficult position at the moment, especially the longer that this gets drawn out. I think folks are betting on Republican wins in the midterm elections later this year, which would make it even more difficult. But now that everybody has come back from the holiday break, we have been seeing a lot in the press about at least trying to pass something in some pared back version. But of course, the Build Back Better Act wasn't just limited to taxes. There was a lot more in there in terms of clean energy, healthcare, a lot of discussion around childcare. So, you know, and some of those may be easier to get through. So, you know, we may see some passage of it. Some of it may not even be tax related. So we'll have to see. I know that some of the representatives in New York State, California have been saying that they're not going to do a deal without the SALT deduction increase. But they also recognize that if there's no deal at all, then they don't get that at all. So we'll see. We'll sort of be watching and seeing what happens. But then moving on to what we've been seeing in the M&A world. So we may be coming up on the year of the tiger, but I think 2021 was definitely the year of the M&A transaction. And so we just wanted to chat about some of the issues that, you know, we've been seeing in deals over the last month or so, or last few months really. And some of these are issues that we've talked about already, but I think because they keep coming up in deals, I think they're worth just repeating again. And there also have been a few new things that we're seeing just in terms of how the market is moving on purchase agreements and other issues. So the first one that I have here are S corporations. We always have S corporation issues. If you're selling an S corporation, it seems like almost every single one of them has some sort of issue because, as we know, there are a whole lot of requirements that you have to go through to make sure that you haven't inadvertently terminated your S election status. Mainly, we're seeing these in making sure that everybody is an eligible shareholder, and also making sure that you haven't, that you meet the requirement of not having a second class of stock. So do you have any corporate documentation that provides for distributions, liquidations, allocations of income that are not on a pro rata basis? And I think the pandemic has maybe added some, we always have these issues in mind, but maybe there are some new sort of fact scenarios that have come up in the course of the pandemic. So for example, people are moving around a lot, doing remote work. So, consider, have your shareholders now moved either domestically or internationally, and can that cause an S corporation issue for you? Or if you're starting an S corporation, so has somebody moved to a community property state? And so Arizona, Texas, don't remember the other ones, but there's a list of about 10 of them. So for community property states, you need both spouses to consent to the S corp election, because the property is treated, even if the shares are only issued to one spouse, if they're community property, then they are treated as owned by both of them. So under the regs, you need to have consent from both spouses. And then, another twist on the community property issue may be, well, okay, your spouse is actually a non-resident, a non-US resident. So now, and this is under the regs as well, if they're under the community property rules of the state or maybe a foreign jurisdiction, could they be considered a shareholder now of that S corporation? And now you have an ineligible shareholder. So those are things that you may consider that may come up in diligence. Probably one of the biggest ones that we see, and this is what the slide here addresses, is an LLC that's chosen to be taxed as an S corporation. A bunch of these were formed a few years back, and oftentimes the tax people aren't involved, and so the LLC is originally set up under a regular operating agreement, just a plain old LLC operating agreement. I have the quotes on this slide come from the template Delaware agreement. And so that operating agreement sort of assumes that the entity is going to be a partnership, and it will have partnership type provisions. And so may have special allocations, may have distributions that are according to capital accounts. And this common one here may have a distribution of proceeds in liquidation that are also according to capital accounts, which may not be pro rata. And so, just the fact that these are there in the corporate documents is important. So it doesn't necessarily matter that the accountants, whoever is preparing the tax return, have ignored these, because, they know the S corp rules and know that everything has to be pro rata. We've seen buyers be very sensitive to this issue, and on the buy side myself, on due diligence, I'm pretty sensitive to it as well. So I think it's a fair issue to bring up. So if you have, and they're not necessarily easy to fix. So if you have an LLC that's taxed as an S corporation, take a look at the operating agreements and do it now, before there's going to be a sale, before you're going to have any other transactional activity, because it's not as simple as just amending the operating agreement, because the termination event has already happened whenever the agreement was put in place, and had an overlapping time period of the S election. And so what we're seeing buyers do is, I haven't done a 338 election in a long time. And I think that's because buyers do not want to take on the risk that a 338 election could be invalid because your S corp election is invalid, right? People like to buy S corporations because they can either do a straight asset purchase from them, and maybe do a true up so it's tax efficient for the seller. Or they could do a 338 election and get that same effect, but with doing a stock sale and avoiding all the messiness of an asset sale, but the buyer would still get their step up in the basis of the assets. But that does rely on, in order to do a 338 H10 election, you need to have a valid S Corp. And no seller wants to indemnify a buyer for the loss of the step up in basis and the resulting depreciation deductions. And so what a lot of folks are doing is doing this F reorg. So the way that it works is that we start with our target S Corp, and the shareholders of the target S Corp form a new Corp, and they drop the shares of the target underneath that and do a Q sub election for the target. And so under Revenue Ruling 2008-18, this is an F reorg. The S election original target S election carries over to the new co. Target does its own Q sub election. Target keeps its EIN, and NewCo gets a new EIN. Although sometimes we will do a protective S election for this entity, especially if we think there's been maybe some S Corp issues in the past. And so then the next step will be that Target will convert to an LLC, and this can be either done by merger into a new LLC, or maybe we'll do it through an 8832 election, basically checking the box so it becomes a disregarded entity again if it was an LLC to begin with. And then NewCo will sell what are then the LLC interests. So NewCo is left at the end of the day with the cash that it can distribute up to the shareholders, and the buyer owns Target in LLC form. And that is basically treated as a sale of the assets of this entity because it's a disregarded entity for tax purposes. So buyer gets their step up, and it doesn't rely on this being an S Corp. So there are still discussions around, whether there could be successor liability if the original S Corp election was invalid, if Target could still have successor liability for any C Corp issues. So, we definitely go through those discussions. But, the other thing that we see in this structure is sometimes NewCo, it's not going to be a sale for cash. There's a rollover element to it. So at the end of the day, NewCo ends up with maybe interests in an acquiring parent LLC or in a C corporation. And I think in those scenarios, what we have to be careful of is, especially if the NewCo will own more than 20%, we have to go back and see if Target has been around since before August 10th, 1993, because then we have to take into account the anti-churning rules, which say that in a sale to a related party, and that's where the 20% comes in, a sale of intangibles to a related party will not allow you to get amortization on those. So, in sales where there's a whole bunch of goodwill, that's an important sort of check to do on your due diligence as you're setting up this transaction. And it is something that can be structured around. So it's just one of those things where you may have an extra step. Another thing, you have to be very careful of the filings on this. So this conversion step of converting it to an LLC by merger or election, that has to be done at least one day after the Q sub election is actually filed, because you need to be an eligible, basically Q sub entity on the day of filing. And there are a couple of PLRs that I've cited here that talk about that timing. It's a frustrating little technical nuance, but it's there. And there was this recent PLR just last year that emphasized that, or sort of reiterated the point. The other thing that we'll see on these issues is, again, if there's rollover, so now that rollover is held by the new co because it is the seller. And so we have to make sure that our shareholders here, especially if there are multiple shareholders, understand that rollover needs to be held by the new co, and it can't be distributed out to the shareholders without taxing that rollover amount. And so that makes it a little bit tricky, especially if you might have one shareholder who wants to get out earlier than the other ones. It's difficult to basically redeem the rollover interests without having gain that passes through to all of the shareholders. So that's just something I haven't really found a good way, around that, because everybody just does these structures. They're, easy to set up. But, there may be some additional thought as far as what's going on with the shareholders' interests. So this is these pre-acquisition conversions. So this is something, it's not necessarily something that we see in acquisitions, but it is something that we've been seeing quite a few times in the last few months, and it deals with converting your LLC to a C corporation. Again, startup companies maybe, had set up their LLCs to take advantage of losses, and then now that they're getting more, maybe more capital, more investors coming in, those investors are interested in converting those entities into C corporations, so they do get the 1202. And so these concerns may change depending on what happens with 1202, but I think even with a 50% exclusion instead of 100%, I think people are still going to be interested. So to do the LLC conversion, basically you can do check the box, or we usually see it basically just converted to a C corporation under law. And generally it should be a 351 transaction, which allows you to transfer property to a corporation in exchange for the corporate stock in a tax-free manner. But there is one big trap for the unwary, or maybe the wary. If the liabilities are in excess of the basis of the assets that are transferred, then you'll basically have boot in the transaction. And so these startup LLCs will often have a lot of debt. Maybe they have convertible debt. Maybe they have shareholder or member debt coming in because they need it just to start up their operations. And so, then the trick is to see, well, what was that money used for? Was it used to buy assets that we essentially have cost basis in? So our debt and asset basis is the same. Or was it used for expenses, R&D expenses, other deductible expenses? In which case, do the LLC members have losses that they haven't taken yet? That could be, yes, maybe you will have 357C gain triggered in this transaction, but are there losses at the shareholder level or member level that have not been taken yet that could be used to offset those? And sort of needing to think about how that works with some of the new limitations on losses, the NOL limitations, and also your now your 461L limitation. So, this isn't really a sort of an M&A issue, but it is something that we've been seeing quite a bit. And then sort of the new thing that we've been seeing are adjustments to purchase price, and specifically in a really expanded definition of debt. It used to be that debt was really, so what you would think of as debt. So did the company have financing, shareholder, like sort of that type of thing. But now we're really seeing buyers expand this to include pre-closing taxes, which we would usually think of being included in net working capital, or maybe just in the tax section to be paid when the tax returns are due. We've been seeing buyers try to include cash to accrual, accounting method change, taxation in their dividends, any unpaid compensation, change of control payments, whether those were here, whether those were in transaction expenses, maybe those aren't, too big. and also CARES Act deferred taxes in here. So, you know, buyers, this one's been a little bit tricky because buyers have been pretty insistent. Although, you know, so we do try and scale these back and it becomes a negotiation point, but I've noticed that these are included, have been included a bunch of LOIs. And oftentimes the tax people are not involved yet at the LOI level. So I would, I guess, caution everybody to, you know, to try to push back on these to the extent that you can, just even starting at the LOI level. Or see if you can scale them back, like for pre-closing taxes, can you scale that back by tax refunds, for example? And then also making sure that there's no duplication in transaction expenses, working capital, or somehow it ends up carving it out of any reps and warranties insurance. And so speaking of reps and warranties insurance, you know, we're seeing this quite a bit in our transactions. And I think, you know, maybe the short statement to say about this is just because there's reps and warranties insurance doesn't mean that you're off the hook, particularly on the tax side. I think when reps and warranties insurance started becoming popular, we saw a lot of tax carve out. I think that's been scaled back a little bit. Maybe insurance companies are a little bit more willing to include more tax items, but it is something that you have to go through because if it's a larger deal, they will be doing their own due diligence and may carve out issues that they see. So state and local, I think pretty much all the time they will carve out transfer pricing, net operating loss, S-corp qualification. So, and those are the big issues that we see that, you know, buyers and sellers are particularly interested in. So I guess I would just say, you know, just because there's reps and warranties, it doesn't necessarily mean that that our job is over, because there could be exclusions. And that, I think, concludes what we have today. And I'm just looking to see if we have any questions. So if anybody has any questions, I don't see any at the moment. But if anybody has any questions, please don't hesitate to reach out. And I think look for an email from Mullen this afternoon with a link to the presentation, as well as the attendance certification for CPE. And please remember to keep an eye out for the invitation for our fiduciary focus program on February 25th. Thank you, everyone.
Great. Thanks, Anna. That's terrific. And thanks, everyone.